Oh boy, oh boy, oh boy, what a week it's been. And today is Friday, February 6th, 2026, and I am Kenny Polcari, your host of the party, and here are the things that you need to know to get your day started. Okay, ready? Today, it's a time for class. And what we have for dinner tonight, we're going to have the spaghetti arrabbiata. Okay, look, it's time for lesson. So just step back for 1 minute because I think this is important, and let's be clear. The trading technology that exists today, the speed at which it happens, coupled with the increasingly complex trading vehicles that react with little to no consideration for fundamentals, is responsible for so much of the blood on the street. And that's my take. Now, set the stage. The lights dim, the curtain goes up, and there he is, Frankie. The crowd applauds, the women faint. And so it is. And then the music starts. The song is familiar, and the crowd roars. It's all very dramatic. You know the song. And now the end is near, and so I face the final curtain. And then here comes the kicker, the one that really gets you. Yes, there were times, I'm sure you knew, when I bit off more than I could chew. But through it all, when there was doubt, I ate it up and spit it out. I faced it all and I stood tall and did it my way. Frank Sinatra, 1969. Unbelievable, such a classic song. And actually, it kind of defines, in my mind, what's happening, right? And there it is. All this AI stuff and the excitement it created now feels like maybe we did bite off a little bit more than we could chew. The narrative is changing. AI that was supposed to assist in the workplace is apparently now eating us for lunch. Just look at the latest Anthropic headlines, right? It makes you crazy. But can we really be surprised? I mean, the Jetsons predicted this decades ago. Still, I'm not convinced that today's negative headlines suggest that the end is near at all. The reality is that the AI theme continues to grow and evolve, and companies are spending money like there's no tomorrow in order to stay in the race. Last year, that apparently was fine. Massive CapEx allocations were met with excitement and surging stock prices. This year, suddenly it's a problem. Those same spending plans are now being met with plunging stock prices and talk of disaster. What's interesting, and frankly ironic, is that investors were happy to bet on AI disrupting entire industries, but they didn't really consider the amount of money required to actually pull that off. And not surprisingly, the trade became crowded. Everybody piled in. Some did it methodically, others did it haphazardly. Algorithms amplified the excitement on the way up. You could practically hear the cash register go cha-ching every day. But when the narrative changes, they amplify the angst on the way down, and it gets ugly fast. And sooner or later, it always does. Those same algorithms, they don't stop and think. They don't sit around the investment committee table to discuss, assess, or debate the earnings reports or CapEx plans. They don't care about the story. They simply switch positions. They go from buy to sell, amplifying the anxiety in the process, right? They are great at accentuating the positives, and they are brutal when they accentuate the negatives. Right now, guess what? They're accentuating everything negative. Even if it's positive, it's negative. Every headline is viewed through the bearish lens, right? The negativity causes the sell algos to ramp it up while the buy algos step back, creating a void in the prices. It's all very orchestrated. And it creates that unmistakable sucking sound, right? And when the trend breaks, it breaks hard. Algorithms respond to price, volatility, momentum, and liquidity. When those signals flip, and they all flip at once, what was the fuel on the way up becomes the accelerant on the way down. Leadership breaks. Selling becomes indiscriminate, and exposure gets cut, especially in the most crowded, have to own them at any price names, right? That's how the euphoria turns into anxiety and why moves become exaggerated. Then the Momo guys, double and triple leverage. They pile in and they hit the sell button too. And the margin calls, that's where the shit really hits the fan. When the bank calls and says, hello, this is a margin call, you have two choices. You either add more money to the account or you hit the sell button. Most people, they'll just hit the sell button, only exaggerating the move lower. And we have not even discussed correlation. When one stretched asset class, think tech, gets punched in the face, the other stretched asset classes get dragged down too. In this case, they crypto and commodities, right? Precious metals, to be specific. Come on, tell me, you had to know that. And the cycle continues and the pendulum swings too far to the right, becoming overbought, and then it swings too far to the left, becoming oversold. We've seen this movie before. So let's look at the relative strength index, right? The relative strength index, the S&P and the NASDAQ are sitting just above oversold territory, which makes sense. The Russell and Equal Weight S&P are in the neutral zone. Meanwhile, the Dow and the Dow Transports, guess what? They're kissing the overbought line. Yes, the overbought line. And that makes sense as well. Money has moved out of the growth trade. The SPYG is down 4% so far this year, and into the value trade, which is up 3.3% this year. Look at the sector performance. I pointed this out yesterday, year to date. Industrials up 8.5%. Energy up 16%. Consumer staples up 11.9%. Basic materials up 11.3%. All considered defensive, value-oriented, and basically boring. So yes, it was another down day as the rout in tech, crypto, and commodities deepened. We can debate the reasons all day. It's like beating a dead horse. Instead, let's look under the sheets. Yesterday, the Dow lost 592 points or 1.2%. The S&P fell 84 points or 1.2%. The NASDAQ dropped 365 points or 1.6%. The Russell gave up 46 points or 1.8%. The transports lost 169 points or 0.9%. The equal weight S&P fell 74 points or 0.9%, and the Mag 7 shed 596 points or 1.8%. Crypto was ugly. Bitcoin traded to 60,000 last night, a 52% drawdown from the high. Ethereum hit 1736, down 64% from the high. Solana tested $67.50, a 73% drawdown. Gold lost $183 or 3.7% yesterday, leaving it down 16% from the high. Silver fell $14 or 16.6% and is now 47% down. Okay, now pull back the sheets on the market because this may surprise you. The Dow is only down 1.1% from its high. The S&P is down 2.8%, the NASDAQ's down 6%. The Russell's down 6%, the transports are still making new highs. The equal-weighted S&P is down less than 1%, and the Mag 7 is down 6.7%. And that is all within what is considered a normal trading range. Now, some of the individual names, and we all have them, may be down more than that. I can name them if you want. But you have to take a step back and look at the whole picture, your entire diversified portfolio, not just one or two names, assuming you have a diversified portfolio. If you do, you shouldn't be panicking. My diversified portfolio is only down 2.5%. That's a far cry from any single name. And yes, I own tech and it's getting crushed, and crypto. I did miss the gold play, but I also own the boring stuff. And that's holding the portfolio together, 𝐊𝐶𝐳? And that is the lesson, period, full stop. Now, bond surge yesterday. TLT was up 1.1%. The TLH gained 0.9 as the market started to believe that the Fed may have to reconsider. Yesterday's economic data came in a bit weaker than expected. The JOLTS showed job openings plunging, and challenging job cuts pointed to a surge in layoffs. The 10-year yield fell 9 bips to 4.18%, and the 30-year fell 7 bips to 4.84%. And by the way, that's good for stocks. Lower rates support risk appetite, unless, of course, you believe rates are falling because the economy is in trouble. An argument that I do not subscribe to, right? I do not think that we're in trouble at all. Now, oil fell $2 or 3.1% yesterday to $63.29. This morning, it's up slightly to $63.35 after a wild overnight range of trading as low as $62.31 and as high as $64.58. It remains locked in that $61 to $66 price range. Gold rallying this morning. It's up $105 at $48.83 as it tries to stabilize after the dramatic move off its highs. It remains in the wide trading range of $45.44 and $5,050. The dollar continues to inch higher. It's up 19 cents this morning at 97.84 after trading as high as 97.95. It's getting closer to the key trend line resistance at 98.50. A move up and through that level would light the fire under the dollar and continue to reprice precious metals, adding volatility to an already volatile complex. European markets are modestly higher, right? That's better than lower. As expected, the Bank of England and ECB held rates steady yesterday, did not change. U.S. futures are higher. Wow. Dow up 170, S&P's up 39, Nasdaq up 172, and that's with Amazon quoted down 8%, while the Russell is positive. The S&P closed at 67.98, down 84 points. We're sitting right on intermediate trendline support. The same level that held back in November when that trend line was closer to 65.34. It held then, and my gut says it's going to hold today. Look, anxiety is high. Nerves are shot. Geopolitical drama and domestic political noise are deafening. But it's mostly just noise. And noise does not price stocks over the long term. My view, I think this is overdone. This is the moment to keep your head on straight. It is not the time to panic. For long-term investors, this is a time to go shopping because there's a lot that's on sale. Call me at 561-931-0190. Let's talk about whether the risk in your portfolio actually matches your tolerance, because that works both ways. You may be taking too much risk, or maybe you're not taking enough. That's going to help you meet your goals at the end. Okay, look, I think now it's getting a little bit ridiculous. A lot of people are getting angry. And so naturally, it's time to whip up the fan favorite, the arrabbiata sauce, because that is an angry sauce. Oh boy, the sauce is simple to make. It gets angrier the more chili pepper that you add, right? You can serve this with any type of pasta you want, but typically spaghetti or linguine works the best. Now for this, you need olive oil, you need onion, garlic, red wine, you need sugar, you need crushed red pepper or chili peppers if you want it really hot. You need lemon juice, oregano, salt, pepper, crushed tomatoes, tomato paste, and chopped parsley. You want to bring a pot of salted water to a rolling boil on the back burner and just leave it there till you're ready. And now in a large pot, a deep saute pan, put it on medium-high, heat up the olive oil and add the garlic. Saute it a bit, don't burn it, 3 minutes or so. Now add in the onion, saute that until soft, maybe another 5 minutes. Now you're going to add in a half a cup of red wine, a tablespoon of sugar, fresh squeezed lemon juice, about 1 tablespoon. You need oregano, you need a bit of tomato paste, you need 28-ounce cans of kitchen-ready crushed tomatoes, not puree, crushed. Then you want to add the crushed red pepper or the chili pepper if you prefer. Bring all that to a boil, then reduce it to simmer, cook it for 15 or 20 minutes. Now, going to add the spaghetti to the boiling water. You're going to cook that for 8 minutes or so until it's al dente. You're going to strain it, always reserving a mug full of the pasta water. Return the pasta to the saute pan and swirl, to the saute pan that's got the tomato sauce in it. Mix it all nice. If it starts to suck up the sauce, you can always add a little bit more pasta water to just keep it moist. You're going to add a handful or two of grated Parmigiana cheese. Mix it well so it's all coated. You're going to serve it immediately in the warm bowls. You're going to enjoy that with a nice bottle of Brunello di Montalcino, and always, always have cheese on the table for your guests. Oh, wow. It is Friday and I'm exhausted. Next week, I will be in New York City. I'll be on the Big Money Show on Monday. I'll be on Mornings with Maria on Wednesday morning from 6 to 9. Until then, take good care.